Starting a business is bold. It's a leap of faith, a commitment to turning an idea into reality. You're investing time, energy, and money to build something from scratch. You're pouring your heart and soul into every decision, every product, every service. As your business grows, so do the financial and tax challenges. Managing finances becomes more complex, and navigating the tax landscape requires careful planning. The government wants its share, but your job is to pay only what you legally owe. It's about being smart, strategic, and compliant. Your business structure can dramatically impact your tax bill. The choices you make now will have long-term consequences. It's not just about what you earn, but what you keep. Profitability is key, but minimizing your tax burden is equally important. For 2025, understanding your options is more important than ever. Tax laws are constantly evolving, and staying informed is crucial for making sound financial decisions. Tax laws may seem confusing, a labyrinth of rules and regulations, but they're just instructions. Learn them, and you can play the game to your advantage. Think of it as a puzzle to solve, a challenge to overcome. Two of the most powerful structures for small business owners, offering both liability protection and tax benefits, are the LLC and the S Corporation. These are the cornerstones of smart business structuring. These aren't just names, they're tools to protect your assets and reduce your IRS bill. They are strategic choices that can significantly impact your bottom line. Many start as sole proprietors, but that leaves your personal assets at risk. It's a simple structure, but it lacks the protection and tax advantages of other options. An LLC creates a legal wall between your business and personal life. This separation is crucial for safeguarding your personal wealth, but protection is just the start. There's so much more to consider. How you structure your business can also maximize tax efficiency. It's about finding the right fit for your specific circumstances. This guide will break down LLCs and S Corp in simple terms, demystifying the complexities and providing clear explanations. Using real 2025 numbers, we'll show you the potential impact on your tax liability. We'll compare paperwork, costs, and rules, giving you a comprehensive overview of each structure, so you see exactly how each structure can save you money. We'll quantify the potential tax savings and help you make an informed decision. By the end, you'll understand these tools and how they can benefit your business, and be ready to make an informed choice, confident in your ability to navigate the tax landscape, protect your assets, and keep more of your hard-earned profit. That's the ultimate goal. Let's dive in and unlock the secrets to smart business structuring. An LLC or limited liability company is essentially a legal container designed to house your business operations. Think of it as a protective shell, meticulously created and governed by the laws of the state in which you operate. It's a framework established to provide a specific set of rules and protections. Before you take the step of forming an LLC, you and your business are legally considered one and the same, meaning your personal assets are directly exposed and at risk in the event of business debts or lawsuits. An LLC changes this dynamic by creating a distinct and separate legal entity, effectively shielding your personal assets like your home, car, and savings from business liabilities. It cleverly combines the benefits of liability protection with the flexibility of various tax treatments, offering a best of both worlds scenario. Best of all, it is generally easy to set up and maintain compared to more complex business structures. LLCs are versatile and can accommodate a wide range of business sizes, from solo ventures with just one member to larger enterprises with many, and the operational rules and compliance requirements are typically less strict and burdensome than those imposed on corporations. When it comes to taxes, the IRS treats a single-member LLC as a sole proprietorship by default, meaning that all profits and losses from the business are reported directly on your personal tax return using Schedule C. Multi-member LLCs, on the other hand, are generally taxed as partnerships by default, meaning that profits are passed through directly to the members based on their ownership percentage, and each member reports their share on their individual tax return. Here's a key concept to remember. An LLC is fundamentally a legal structure, not a tax structure in itself. While the IRS has default rules for how it will tax your LLC, you often have the option to elect to be taxed as either an S Corp or even a C Corp, depending on your specific circumstances and financial goals. This inherent flexibility is what makes the LLC such a strategic and valuable tool for small business owners. You benefit from the crucial liability protection it offers, and you also have the power to pick the tax treatment that best fits your unique business needs and financial objectives. That's precisely why LLCs have become so incredibly popular among entrepreneurs and small businesses. They offer a simple, protective legal structure that is also remarkably adaptable to a wide range of business situations. Next, let's delve into the world of S corporations and see how electing this tax status can potentially change the tax game for your business. Understanding this choice and its implications is absolutely crucial for maximizing your profitability and improving your bottom line. An S Corp or S corporation isn't a business you form directly at the state level. It's actually a tax election you make with the IRS, the Internal Revenue Service. Think of it as a special designation that changes how your business is taxed. First, you form a legal business entity, typically an LLC or a C corporation. This establishes the foundation for your business operations. Then, after forming your LLC or C Corp, you file a special election with the IRS to be taxed as an S Corp. This election essentially tells the IRS you want your business income to be taxed in a specific way. The main reason businesses choose this S Corp election? To save on self-employment taxes, which can significantly impact your bottom line. As a sole proprietor or standard LLC, where you haven't made the S Corp election, all net profit is generally subject to a hefty 15.3% self-employment tax. This can take a big bite out of your earnings. With an S Corp, you have the opportunity to split your earnings into two categories: a reasonable salary and a profit distribution. You pay payroll taxes, including Social Security and Medicare, on your salary, just like a regular employee. But the portion of your earnings taken as distributions avoids that self-employment tax, leading to potential savings. This strategic allocation of earnings is the core S Corp tax saving strategy, and it's why many businesses find it appealing. To qualify for S Corp status, your business must be domestic, meaning it's formed and operates within the United States. Additionally, you can have no more than 100 shareholders, and you must meet a variety of other specific IRS rules and regulations. If you break any of these rules, you risk losing your S Corp status, which can result in a significantly larger tax bill and potential penalties. S Corp offer the potential for great tax benefits, especially for profitable businesses. However, they also come with more formal rules and increased responsibilities compared to a standard LLC. For example, you must pay yourself a reasonable salary that reflects your work in the business, and you must adhere to strict compliance requirements. But if you manage your S Corp correctly and follow all the rules, the potential tax savings can be quite substantial. Ultimately, S Corp status is a powerful tool that can contribute to the financial success of profitable businesses. Next, let's dive in and see how taxes typically work for a standard LLC without the S Corp election. For a standard LLC, the IRS treats you as a sole proprietor. All business profit flows onto your personal tax return via Schedule C. You pay regular income tax on this profit, plus a 15.3% self-employment tax. For example, $100,000 in profit means $15,300 in self-employment tax, on top of income tax. You pay both the employer and employee share of Social Security and Medicare. While you can deduct half the self-employment tax, the overall hit is significant. This is why many LLC owners look for a better tax strategy. The S Corp election can change this picture dramatically. Let's see how. With S Corp status, you keep your LLC's legal protection but change how profits are taxed. You must pay yourself a reasonable salary, processed through payroll and subject to FICA taxes. Only your salary is taxed at 15.3%, not your entire profit. The S Corp deducts your salary and payroll taxes as business expenses. Remaining profit is distributed to you and avoids self-employment tax. You still pay income tax on distributions, but you save 15.3% on every dollar classified as a distribution. For example, a $50,000 distribution saves you $7,650 in taxes. This is the S Corp advantage. Split your income, save thousands. That's why many profitable LLCs elect S Corp status. Let's see a side-by-side example. Imagine two identical businesses, each with $100,000 in profit. Business A is a standard LLC business. B is an LLC taxed as an S Corp. Business A pays $15,300 in self-employment tax on the full profit. Business B's owner pays themselves a $60,000 salary, taxed at 15.3%. That's $9,180 in taxes. The remaining $40,000 is a distribution, not subject to self-employment tax. The S Corp owner saves $6,120 in taxes compared to the standard LLC. Both still pay income tax on $100,000. but the S Corp structure reduces payroll taxes. The savings come entirely from reducing self-employment tax. This example shows the real financial power of the S Corp election. For profitable businesses, the difference is thousands of dollars. But S Corp come with extra responsibilities. Let's look at the costs and trade-offs. Is it worth it for you? S Corp offer tax savings, but they require more work. LLCs are simple, minimal paperwork, easy compliance, and low fees. S Corp require payroll, tax filings, and stricter record keeping. You'll likely need a payroll service and an accountant, adding costs. If your profits are low, these costs can outweigh the tax savings. But as profits grow, the savings quickly surpass the extra expenses. The key is to do the math for your business. Weigh simplicity against savings to find your best fit. Next, let's see when each structure makes sense. The right choice depends on your business's profits and goals. For new or part-time businesses like Maria the freelance designer earning $25,000, a standard LLC is ideal, simple, protective, and cost-effective. For profitable businesses like David's consulting firm making $120,000, S Corp status can save thousands, even after payroll and accounting costs. In partnerships, an S Corp lets working owners take salaries and passive owners receive distributions, maximizing tax efficiency. The structure you choose should fit your business's size, complexity, and growth plans. Start simple, then upgrade as your profits grow. There's no one-size-fits-all answer. Run the numbers for your situation. Consider your tolerance for paperwork and compliance. The right structure can save you money and protect your assets. Consult a professional if you're unsure. Your business deserves the best foundation. Let's wrap up with a decision checklist. Ready to choose? Here's how to decide for 2025. Estimate your net profit. If it's under $40,000, stick with a standard LLC for simplicity. If profits are higher, research a reasonable salary for your role. Calculate the tax savings. Compare 15.3% on total profit, LLC versus 15.3% on salary only, S Corp. Factor in payroll and accounting costs. If savings are significant, S Corp status is likely worth it. Consider your willingness to handle extra paperwork or hire help. Remember, you can start as an LLC and elect S Corp status later. Consult a CPA or attorney to confirm your numbers and stay compliant. Investing in professional advice can save you thousands. Make the smart choice for your business's future. Protect your assets, minimize taxes, and set yourself up for success. The 2025 tax game is yours to win.